Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com. Welcome back, everyone, to Real Estate 360 Live. I am your host, Ryan Sloper, joined by my guest, Louis Cammarosano, the general manager of HomeGain. Quick reminder, Real Estate 360 is designed to build Washington, D.C.'s housing and credit markets one house at a time. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030. Or via the web at realestate360live.com. That's realestate360live.com. When you go there, there's an Ask a Question button on the right-hand side. Feel free to use that at any time if you have any questions that you would like me to directly answer, whether it's in regards to refinancing your home, whether it's buying a home, selling a home, credit issues, trying to get yourself squared away so you can potentially buy a home. I can help you with any of that. And if it's something, for some reason, I cannot help you with, I'd be glad to point you in the right direction with a professional that can. Like I said, that's 877-245-2030. So we're going to jump into this week's Market Movers. This segment was brought to you by HomeGain. HomeGain is the place to get you started buying or selling a home, finding a realtor, and getting real estate questions answered. Go to homegain.com today to see what I'm talking about. All you have to do is type in your home address, and you'll get an instant free estimate of your home's value online. It's a great way to monitor your home's value, and it's totally free. So check it out today at homegain.com. So, Louis, you had asked me, obviously the big market movers for this week is going to be the Fed meeting, where Chief Fed Chairman Bernanke and his crew will, later this week, decide what they're going to do. And obviously, you'd asked me, do I think they're going to continue with Operation Twist? I do think that they're going to continue Operation Twist. However, there's only so many short-term bonds that they can actually swap out. So I don't know if it's going to have much effect. And like I said, at this point, interest rates where they're at, I believe that the lenders are not really passing on the lowest interest rate possible to the consumer at this point. It's really padding the pockets of the actual lender.
Right. Now, it may not have much of an effect, but there's no way they pass up an opportunity not to roll over those short-term securities into longer-term ones.
Absolutely not. I mean, this I'm going to say 100% that that's going to happen. As far as like more QE, that I'm a little bit questionable on, because I'm not sure. I'm not sure if it's something that Obama is really going to push for. I believe he said something. I was last week about private sector jobs and how, he wasn't that concerned. I mean, it's a big concern because, it was stated that over, I believe it's been the last 4 years or something like that, that actual private sector employment has tanked by something like 11% or something like that, or was it more than that?
Yeah, the point the president was making was that, because he's an advocate for public spending and public sector jobs, is that we've lost a lot of public employees because of budget cuts throughout the state.
Yep.
So he was saying, the private sector is not doing as badly. He was arguing for more spending for jobs, bureaucrats, teachers, firefighters, police, and so on.
So if that's kind of in line, if that's his line of thinking, I mean, who's to say that the Fed might not spend some more money?
But the Fed, if they were to spend money, all they would be doing would be increasing the balance sheet by printing up more money. I don't know if that would give an argument to the Congress that they can go ahead and offer more stimulus money to the states, because if they want to they would do that anyway.
Yeah, well, and I was actually curious as to why they maybe hadn't approached that subject at a certain time, because they were so willing to give money to everybody else. I mean, why not give to the states, or at least let them borrow money at relatively.
Well, if you think about it, what the states are doing right now is somewhat akin to Greece. They're having to get their budgets in order because there is no any more federal bailout.
Yeah.
I know that California put a budget together on the assumption that in November they're going to ram through a tax increase that the voters are going to vote for.
Right.
If that doesn't happen, then California has a budget shortfall. But I agree with you. I don't think there'll be a QE3 in terms of printing more money. One, because it won't help the political system, And two, I don't think it helps the banks at all because they already have their low interest rates.
Yep.
So what would be the point of doing it other than to adjust liquidity if there's some type of emergency? But it looks like they put off the Greek emergency for a few months, and unless something happens in the next 2 days to Spain or Italy, there's no pending emergency that's imminent.
No, not at all. And you know,
and they want to do it. I mean, they have to keep the game going. They have to keep printing more money, but I don't think they have to do it this month.
no, and like I said, I mean, I think that for at least the foreseeable future into like right up to the elections, right after the elections, I don't really see much happening. I mean, typically, if you look back historically in the year of election, not much gets done. I mean, if we were like facing a catastrophe like as of tomorrow, then maybe yes. But I think that this is something that they can just continue to push out, deal with it next year type of thing.
Well, because they're not even dealing with it even when they do QE3.
No.
They're just printing money. That's how they view dealing with it. But in their mind, they think that they don't have to deal with it right now because it's taking care of itself.
Right.
I would hope they'd stop doing it altogether, but it's inevitable that they'll continue to do a series of QEs.
Yeah, for the foreseeable future. So, you know, and I want to kind of segue because, you know, it's great. Like, you know, the Fed's manipulating the markets and mortgage rates are staying at all-time lows. And I have so many frustrated, you know, clients out there and listeners that are saying, you know, well, it's great. You're telling me that we can take advantage of this stuff. And, you know, we're trying to get our loans put in and we're getting, you know, declined for numerous different reasons. And I want to kind of put an emphasis this week on FHA, which are government-insured loans, and VA, which is insured by the Veterans Administration for military personnel. And there's a specific loan that's basically a streamlined refinance, which basically means that if you have an existing FHA loan or an existing VA loan, that you should be allowed to do a streamlined refinance, which basically means that they don't have to take your income, they don't need your, didn't need your credit, didn't need any of that. As long as you made your last 12 payments on time, that you could refinance that loan into a lower rate. Well, those loans are still out there, but the problem is, and I kind of alluded to it earlier, that FHA has a set of guidelines, VA has their set of guidelines, but then once you go and you apply for that loan through Wells Fargo, Bank of America, or whatever other bank you may use, they can then have their own overlay of guidelines that they can say, well, that you meet the basic criteria, but you know what, this one thing we don't like. Now, I'm going to give you a couple examples. Example number one was a client that actually was trying to get a VA streamline done. Had, I want to say it was probably like, scores probably close to 700 or so. And they had an actual credit card late within the last 12 months. It was a credit card that I want to say had some sort of like auto renew membership from like Netflix or one of those subscription type sites that was supposed to be turned off, but it kept billing the person's account, and they were in the process of getting it fixed. However, to get a letter saying that was a mistake was going to take like 30 to 45 days. In the midst, they're trying to take advantage of these interest rates. So basically, the lender at a certain point said, no, you had a late within the last 12 months on something that was outside of the mortgage, even though the only real guideline is that you just can't have missed a mortgage payment in the last 12 months. The lender had an overlay that said, no, we don't want that because you had a credit card late in the last 12 months.
When you say the lender had an overlay, you mean an internal policy?
An internal policy that supersedes the actual FHA or VA guidelines, which is what they're supposed to be going off of, but they can, have an internal policy, and there's numerous of them. They can go, you must have this credit score, you must have an appraisal where there's not an appraisal needed. And the bad part about that is, Lewis, is once one lender does that, what do you think they all do? They all start to adopt those policies, and it makes it a mess, an absolute mess. So for all these people that are like happy and thrilled, they're like, yeah, I'm going to take advantage of these rates, and then all of a sudden they find out, oh, well, the original originator, the loan person, whoever's taking the initial info is like, yeah, this is going to get done, because they don't realize that all in the midst of all of this, there's people behind the scenes that are changing guidelines every single day. I mean, it's impossible to actually, to even put your hand on it to say if a loan's going to go through or not going to go through these days, because there's so many intricacies and changes to policies and guidelines that, for one person that may get a loan, and you have a second person that has the same exact credentials but goes to a different bank or lender, it might get turned down. And, that was one example. Another example is that, these supposed streamlines were there was not an appraisal necessary to do a streamlined refinance. It was supposed to be streamlined. There's nothing really to it except for not missing your mortgage payment in the last 12 months. Well, now a lot of lenders are actually requesting that an appraisal's done. Well, guess what? How many people are in an upside down position right now? So if they get an appraisal and it comes back and they're at basically 140% of what the house is actually worth, do you think the loan's going to go through? Probably not. That's not a guideline that's set forth by FHA or VA. However, it's, internal underwriting guidelines that are added on are making that way. So, I want to
what interest would the lender have to put those types of restrictions, which really they don't really protect themselves with those types?
Because majority of these guidelines are put in place because there's got to be a secondary market for these loans to be resold, and there's not an appetite for them. And there's not an appetite for them, especially at the interest rate levels that they're at. So
unless the Fed does a second round of mortgage purchases.
Yeah, so just effectively, if you have like a group, let's just say it's a bundle of like 30 FHA loans, and most of the big lenders are just they're originating the loan, they close in their own name, and then they bundle them and sell them off to Fannie, Freddie, or whoever else they've got lines with that they're going to sell to a servicing company. Well, a lot of the times, if everything doesn't hit the criteria perfectly, then they don't have an end buyer for them. So what they try to do is they go back to the Fannie or Freddie or whoever's buying the loans and say, well, what do you want here that would let you have an appetite for this loan? So even though those guidelines aren't set forth, they'll kind of say, well, we'll buy this if you have this, meaning like you're under 100% loan to value or credit scores over 640. They can kind of, let them know what they want. So they change their policy so they make sure that they have an end buyer for these loans. Does that make sense?
Oh, that does make sense.
So it's not really that, it's just in their interest to do it. There's always a motive, and the motive is money. So they want to be able to...
So the money they're making is not it's not for the creditworthiness that they expect to receive the income stream from making the loan. It's from selling the loan to the...
The upfront loan profits from actually originating the loan and then selling it on the secondary market. You've got it. We're coming up on a break, guys. When we come back, shadow inventory has supposedly fallen to levels not seen since 2008. Stay tuned when we come back.